Let's talk about how traditional banking relationships work. They're going to underwrite you and your asset, and then they're going to approve or deny, and then they give you a loan if you're approved, and they're going to hold on to that loan long term. Now, once you have this loan and you have this mortgage with the bank, if you run into an issue with financing, say you're struggling, you might not be able to pay the loan, or you got to miss some months, you can call up that bank and then you can maybe negotiate some kind of forbearance, maybe able to just see what your options are. But you can talk to the bank because the bank has that loan. Now, in the case of a CMBS loan, they're going to underwrite you in the asset, and then once they approve you, they're going to give you that loan, and then they're going to sell that mortgage. They're going to package it with other mortgages, and they're going to put it into a bond and then sell it to investors. That's what they mean by commercial mortgage-backed security. Now those investors have your mortgage, and that mortgage is a part of a bond with a whole lot of other mortgages. So now in this case, the bank no longer has your loan. So if you run into an issue trying to pay back that loan, you can't just call up the bank. Now your loan is part of a bond with a whole bunch of other loans, and now the investors have it. So now you can't just call it the bank Essentially, you don't have the same, freedom or flexibility when it comes to loan servicing with a commercial mortgage-backed security because the bank that you went to no longer has your loan.